Stuart, I know before the FOMC decision and press conference, your take on this was that markets, at least in equities, are really much more focused on earnings. Did this idea of a rate cut in September change that idea?
I don't think it really changed our base case. This morning we were really rallying on, the Microsoft earnings from last night and some related earnings there. The FOMC, I was actually kind of surprised. I mean, the statement was a little probably more hawkish than the market might have expected, and equity futures didn't react as much, which did surprise me. I think once we got into the press conference and it became, clear that the Fed was sort of parroting what we've seen from the data, right, which is a solid labor market, easing inflation, and kind of a cut-minded FOMC, the market did respond positively to that. But, if I were to rank out the big catalyst this week, I would probably put earnings and payrolls a little bit ahead of the Fed in terms of the impact on markets. And I think that's kind of largely what you saw this afternoon in totality.
When you talk about, Stuart, the idea of what this market is pricing in with regards to rate cuts and this idea here that the Fed, at least right now, seems to be leaning into this idea that the data is pointing them in that direction, will that take precedence, whether it's at September, November, or in the December meeting?
Yeah, it really does matter, especially to the extent that they're actually cutting rates into a solid economy. And, our view coming into the year was you don't need rate cuts, but if you are getting rate cuts, it's the why that matters. And if they do 2 or 3 cuts and you're priced for about 2.5 cuts in the fourth quarter, and that happens against, let's say, payroll data that's still 150 to 200K, I think the markets will respond exceptionally positively to that. If they end up cutting, but it's in response to a weaker labor market, to me, that's a much, much different discussion. And I do think you have to worry about equity risk in that case. So, yeah, look, I do think insurance cuts in the back half or in the fourth quarter this year would be extremely positive for the markets. But, the real question is going to be, are they cutting into a strong labor market, or are they cutting because they're really worried about a deteriorating labor market in the next few months?
Yeah, which sets us up for Friday. And it was very apparent in Powell's presser that the jobs data is that critical metric for a September cut. What are the options, Mark? What's the options market in the S&P telling you for Friday now?
Yeah, I mean, you're pricing, something like a 1% move on Friday, which is a pretty large implied move ahead of a payrolls print. That said, you also get Apple and Amazon after the close on Thursday. So I think that 1 to 1.2% move has kind of been fluctuating throughout the day. I think that's capturing payrolls as well as those kind of key earnings prints. But look, our baseline view for equities this year is you run long equity risk unless and until the U.S. labor market comes under significant pressure. It does seem like the Fed is also kind of navigating in that direction, too, with kind of payrolls as the number one thing they're focused on. So it doesn't surprise me to see a lot of risk priced into payrolls because, we do see it as kind of the key risk indicator for markets. Consensus about 175K. Our U.S. economists are actually a bit below that. And I do think if you printed something sub 150K, it would definitely get the market's attention in terms of, kind of a broader slowing in U.S. labor markets.
Stuart, you say that earnings matter for the big cap tech stocks. Clearly, the jobs report matters for the equity market as well. Do earnings matter for the Russell 2000, or is it still a rotation that continues because of the macro trends?
Yeah, look, I do think earnings obviously matter for small cap. It's a little tough because, only about 700 stocks in the Russell actually have positive earnings. So, like the day to day, what is EPS on the Russell probably matters a little bit less than are we continuing to get soft landing data. But, so I think earnings matter more for S&P and NASDAQ right now, sort of, tick by tick, day by day, what are companies reporting. But look, the Russell is a more growth sensitive equity asset, and it's going to respond to that growth data because it is translating through to, what is the earnings profile and what is the credit risk of those small cap stocks. Honestly, one of the things we've been really focused on with investors is owning small cap, but doing it through that smaller kind of 600 to 700 stocks within within the Russell 2000s that actually produce positive profitability.
Are those correlations still there, Stuart? I mean, when you lay out that scenario, that sounds to me a little bit more idiosyncratic rather than something that is broadly defined.
Yeah, look, I think coming into earnings season, folks were looking at least at large cap tech earnings as a little more idiosyncratic. But the problem or the challenge is within that tech ecosystem, there's a lot of feedback, right? The CapEx that's getting spent by, let's say, a Google or a Microsoft or a Meta, that CapEx is then getting kind of consumed by NVIDIA and the semi stocks. So as much as you do have some idiosyncratic stories, you also have, I think, this very strong interlinkage amongst those large cap tech stocks, which is why the Google report last last week, which kind of hinted at maybe some weaker CapEx, became so disruptive. You know, at the Russell level, yeah, I think there's a lot more idiosyncratic risk down there, but it's just also not as well covered, right? There's not as much consensus coverage of those names. There's a little bit less focus, I think, on stock by stock or company by company. What are they doing from an earnings perspective?